Today we are going to be covering 4 rules out of the 12. These rules lay the groundwork and provide you with a solid foundation to begin investing successfully. So there's no shortcuts here. We're going to go through the 4 rules exactly as we cover them in the Complete Simply Investing course. The first rule: will people still be using this product or service in 20 years? So before you consider any stock or share for purchase, you want to think about this for a moment. Whatever company you're thinking of buying and whatever they're producing, will people still be using it 20 years from now? If the answer is no, or maybe, or I think so, then don't buy the stock. Okay, I don't care if your colleagues at work or family members, your brother or sister is telling you this is going to be the hottest stock, it's going to triple in value in the next 6 months. If you can't answer this question or satisfy this rule, then do not invest your hard-earned cash into this company. So what are some of the things that people will still be using 20 years from now? People will still need mortgages, still need to buy homes, financial services, food is another one. And it's kind of funny, I was teaching this class in Montreal a few years ago and somebody raised their hand and they said, clothes. And it's true, people are still going to need clothes 20 years from now. What we're trying to avoid here are fads or sort of the latest fashion or gadgets that people are interested in, because I don't know if they're still going to be in demand 20 years from now. And so you don't want to be investing in those because they're higher risk. You want to invest in things that are certain and that it's going to reduce your risk. The next rule: is the company recession proof? Now think about this for a moment. If you were to lose your job, or the economy was down, or there was a recession, would you go out and buy a new car? Would you go on vacation overseas? Or buy expensive items or luxury items at all? Of course not. You're not going to buy a new car, you're going to keep the one you have, and you're going to keep it running longer and just maintain it. Or you start taking the bus. In terms of vacation overseas, you're probably going to go on vacation locally, within driving distance. You're not going to spend money on airfare and hotels when you don't have a job or potential for being laid off and losing your job. So right away that knocks off companies like car manufacturers, aircraft manufacturers, tourism companies. Those companies are not recession proof. When the economy goes down, when there's a recession, people are losing their jobs, they're not going to be buying those items. So you do not want to invest in those companies. No one knows when the recession is going to happen or the next one's going to occur or how long it's going to last. So you don't want to invest in those companies because your investments will go down. However, we do know of some of the things that are recession proof, right? What's the first thing you do when you come home at night? You turn the lights on, right? What do you do in the winter or when it gets cold? You turn the heat up. People are, even when people lose their jobs, they're still going to need to brush their teeth, they're still going to need toilet paper, they're still going to need, as I mentioned, electricity, oil for heating your home. They're still going to need those things. So those are the companies you want to invest in, the ones that are recession proof, because again that's going to minimize your risk. The next rule: has the company had consistent dividend growth? So before we answer this rule, I'm going to take a couple of slides to talk about dividends and the importance of dividends. Okay, what's so great about dividends? At the end of the day, it's money in your pocket. It's cash. You're earning money while you sleep when you're earning dividends. Okay, there's no staff to manage. If, for example, if you owned your own business, there's no tenants to chase after for the rent if you were involved in real estate investing, or there's no tenants calling you in the middle of the night to complain about a leaky toilet. Okay, once you've bought the stock, just sit back and collect the dividends. Okay, and this is huge importance. I mean, some people have stopped working because they collect enough dividends each year. And one of the more famous examples is Derek Foster, who retired at the age of 34, and he lives off of his dividends. Let's take a look at a concept called dividend yield. So the dividend yield is quite simple. It's the dividend divided by the share price. So in this example, we have a company that is paying $1 a dividend per share, and the share price today, let's say, happens to be $10 a share. So the dividend yield is going to be 10%. So let's say you bought 200 shares at $10 each, so you spent $2,000. So your investment was $2,000 in buying shares in company XYZ. If the dividend yield is 10%, 10% of 2,000 is $200. So this means you will receive $200 cash every single year for as long as you own those shares and as long as the company continues to pay $1 a dividend per share. So the dividend yield is basically telling you what is the return on your investment. Here are some sample dividends today. Coca-Cola is $1.88 per share, and we've got Walmart in there, Starbucks, and Microsoft. Now some people are going to look at this and say, well, this is peanuts. I mean, 52 cents per share, it's nothing. You know, I can't retire off this money. I'm not even going to have enough money to spend on the things that I want to buy. The important concept here that most people miss is that over time, dividends increase. So this is very important. This is another one of those investing secrets that most people are not aware of. Over time, dividends increase. So it may not sound like a lot. You know, you're earning 10 cents a dividend or 15 cents a dividend, but over time they do increase. Let's take a look at the first example again. So the dividend is $1 per share, and the share price was $10. And let's say you bought 200 shares, right? So you're going to get 10% return on your investment. So in the first year you'll get $200. Let's say in the second year the dividend goes up. So now you're collecting $240 in dividends. Year 3, dividends go up 30 cents. And then year 4 they go up again, and year 5 they go up again. So take a look at that table in the very last column, the fourth column. You started collecting $200 in dividends in the first year, and by the 5th year you're collecting $420. Okay, now take a look at the third column, which is the dividend yield. So the dividend yield based on the original purchase price was 10%, and now by the 5th year you're earning 21%. So this is very important. Over time, dividends do increase, and you can generate a lot of money. Here's a personal example of mine. In 2000, I bought 185 shares of TransCanada Pipeline at $13.40 each. This means I spent $2,479. That was my initial investment to buy the 185 shares. Ever since I've owned those shares, TransCanada Pipeline has increased the dividend every single year. So I started off in 2000 earning 80 cents per share. That was the dividend. Today the dividend is $1.68. So again, if you look at that table in the very last column on the right, the third column, and look all the way down, you will see that the dividend yield based on the original purchase price, today I am earning 12.5% on $2,479. That was my initial investment. I can't get 12.5% anywhere. A term deposit or a GIC is going to pay maybe 2.5, maybe 3%. How much does a savings account pay today? Is it 0.1 or less than 1%? So 12.5% is a really good return. And again, now I just sit back and collect the dividends. There is no maintenance to do, there's no people to call, there's no other work involved. There was the work involved back in 2000 when I did the research and decided to buy TransCanada Pipeline, and I put the order in online, which takes literally 3 to 4 minutes, and that was it. And it gets even better now. Let's take a look. The total amount of dividends received since 2000 is $2,382.76. The total amount of dividends that I've received is almost equal to the initial investment that I made. So when I first bought the shares in 2000, what was my risk? The worst thing that could have happened is the company could have gone bankrupt. Now it was highly unlikely. It was and still is one of the largest companies in Canada, a market leader in their industry. They've been around for a very, very, very long time. But nevertheless, the risk at the time was that I could have lost all of my money, $2,479, if the company went bankrupt. The risk today is only $96 because I've received $2,382 in dividends. So today, if the company was to go bankrupt, well, I would lose $96. By next year, my risk will be zero, because by next year I will have received enough dividends to cover my initial investment. So the stock price as of October 19, 2011 was $43, which represents a return of a little over 224% increase. Including dividends, the return is 314.4%. And the dividend yield based on the original purchase price is 12.5%. So remember, I purchased these shares when they were $13.40. Today they're trading at $43.49. Do I care if the stock price drops to $30 tomorrow? Or even $20? Or even $15? No, because I'm still making money. And I'm earning 12.5% cash every year on this investment. So this is the ultimate goal, is to have every stock in your portfolio get into this situation where it's returning a dividend yield in the double digits, and you've received enough dividends over the years to cover your initial investment. So this is very powerful, and it does require some foresight. If you can think, 5, 6, 7, 10, 15 years ahead, that you're going to be needing X amount of dollars or X amount of income coming in into the future, you have to make those decisions today, those investment decisions today, so that in the future you will have that income stream coming in. Okay, one last example. This is another real-life story. This is a gentleman by the name of Tom Connolly in Kingston, Ontario. This is his example of Bank of Montreal shares. In 1985, he purchased 400 shares of Bank of Montreal. The dividend at the time was 25 cents. So the dividend yield at the time was 4.24%. And his total investment was $9,250. In 1993, the bank decided to do a 2-for-1 stock split. For those of you who are not aware, a 2-for-1 split basically means that you end up with double the amount of shares. Now the stock price does come down accordingly, because now you have double the quantity, but I've seen in my experience that over time the stock price creeps back up again, which is great for investors. So in 1993, Tom Connolly ended up with 800 shares of Bank of Montreal. In 2001, they did another stock split, so he ended up with 1,600 shares of Bank of Montreal. Since then, the dividends have increased every single year. So as of last year, the dividend was $2.80. So the dividend yield based on the original purchase price is now 48.44%. 48.44% of $9,250 is $4,480.70. That is the amount of dividends he receives every year in cash that's deposited into his trading account, and that is huge. The other thing to consider is the stocks today. His $9,000 investment is worth over $100,000. Let's take a look at dividend risk. Now, people are going to say, well, dividends are not guaranteed, and that is true. Companies are under no legal obligation to pay you any dividends, even if you are the shareholder. Companies can reduce the dividend or eliminate it altogether at any time, especially if things go bad, if there's a recession, there's layoffs happening, the company is losing money, they can reduce or eliminate the dividend at any time. So dividends are not guaranteed. However, what you have to consider is the history of some of these companies who have been paying dividends for many, many, many years. That's going to help us to determine whether or not the risk to dividends is worth considering or not. Like, how real is the risk? Is it really going to hurt you as an investor? So let's take a look here. Is a list of companies that have been increasing dividends for the last 25 years consecutively. Okay, so that's a big list. You've got 26 companies on the list.